Alrighty. So in today's video, we are going to be talking about rolling short strangle. So I've got a number of people that have requested for this video for quite some time now, and I'm sorry that it took a while, but hey, it's finally here. So let's dive right into this. So first off, right, when we start off with a short strangle, right, a neutral short strangle, generally we want to start off with the 16 delta, right? So basically this is how we enter into a short strangle, and basically 16 deltas on both sides is the expected move, right? So I've already created a video on the expected move. If you haven't watched that, just go ahead and find that on my channel. And if you're a little bit more aggressive, you can go for a little bit higher delta, maybe up to 20 or even 25 delta. Now, when it comes to rolling, I personally have a few golden rules that I follow, right? So I have 3 golden rules when it comes to rolling short strangles. Now, these are my personal rules. You can choose to follow them if you want to. If you don't want, that's fine as well. So the very first rule is that I only roll the untested side. So what do I mean by untested side? So let's say, for example, if the market goes down, right? So the put side right now is the tested side. So the untested side would be the short call. So I will only be looking to roll the short call down instead of, rolling the short put. Okay, and the reason I do that is that if you were to roll the short put down, most of the time it's going to be for a debit, right? Even though you try and roll the call down as well and you roll the put down, chances are it's going to be for a debit because, rolling down the put is going to be more expensive than, the credit you're going to receive for rolling the short call. So that is why I only choose to roll the untested side. Now, rule number 2 is that I do not roll out in time, but rather I just close around 21 DTE, regardless if it's a profit or loss. So what do I mean by I do not roll out in time? So some people, let's say, for example, if the market goes down here, they may choose to not only just roll down here, right? You roll your short call down, but they also choose to roll out in time for both the strikes, right? So maybe at this point in time, maybe they have about, 25 DTE left, right? Let's just say there's about 25 DTE left. And what they would do is that they will roll down at the same time they will roll out as well. So maybe they roll out to the next 45 DTE. And for the bottom one as well, they will also roll this to 45 DTE. So like this, overall, you actually get much more credit than if you were to just, roll down by itself. So the reason I do not actually do this is because when you roll out to a further time, yes, you get more credit, but it's essentially the same as just you're putting on a new position altogether. But this time when you put on a new position, right, what happens is that you will start off with a much smaller strangle, right? So your new strangle will now be, you still retain this strike, but now your profit zone is much smaller. And that's the reason why I do not really like to roll out in time. But it's definitely fine if you like to roll out in time. Now, you like to hold on to the trade slightly longer for it to work out. My personal preference is that I would just close out if it's a profit or a loss regardless, right, at around 21 DTE, and I wait for the next opportunity again before I open up another trade. Now, rule number 3 is that I do not become inverted, right? So the maximum would be to roll into a straddle. So what I mean by I do not want to become inverted, right? Inversion basically just means that you will keep rolling one of the strikes until it goes below or above another strike, right? Let's say, for example, if the market keeps going down this way, and over time, you can just keep rolling your call, right? Maybe your call will be down here. And then as the market further goes down again, this is where you can keep rolling your call until the point where your call option can even be below your put option. So this is what you call an inversion, an inverted strangle. And this is something that the Tasty Trade folks, they talk quite a bit about. And the reason I don't like to do this inversion because, it gets a little bit complicated when it comes to the calculation. So I like to keep things simple. I like to keep things very neat. And if you do not like to, feel confused, you do not like to see that there's this inversion and, you're not sure what to do, then you do not want to become inverted as well. But for those of you who are very, very, sophisticated and you're very sharp, you know exactly what you're doing, then yeah, there's nothing wrong with going inverted as long as you know exactly how to uninvert it, right, when you want to get out of this inversion. Okay, so with these 3 golden rules in mind, let's get into rolling. So how do we actually roll the short strangle? So there are 3 methods that I'm going to share with you. So the first method is to roll based on delta. So what do I mean by this? So what it means is basically to roll the side where the delta has dropped to below a certain number. So remember, we start off at 16 delta. So if either side actually drops below 10 delta, then that's the one where we'll consider rolling it, right? So for example, let's say the market goes down and now the short call is at 8 delta, right? So if the market goes down, basically your put side, your short put will pick up delta, right? Basically it will increase, and on your call side, it will drop in terms of delta. So at this point, this is where you can consider to roll down your short call, as this is what I call the untested side. Now, theoretically or technically, this short put has not been tested, right? But it's getting close to being tested because the market is going down. So I will just consider the call side down here, the untested side, right? Similarly, if the market goes up, then the put side will be considered the untested side. All right, so this is where you will consider rolling your untested side. So in this case, it will be the short call. So the question now is, what delta do you roll it to? All right, so there are two options for this. The very first option is that you can simply just roll back to the initial delta. So what you want to do is you just find the option that has 16 delta and you roll to that one, right? So if you started off with a 20 delta, then you could just choose to roll to the 20 delta. Or if you're a little bit more conservative, you could just choose 16 delta or 15 delta, right? Now, the second option is that you could roll it to a slightly higher delta, right? So if you start off with 16 delta, maybe you might want to roll it to 25 deltas or even 30 deltas, right? So basically it's above 16 delta. And this basically is when you are a little bit more bearish on the underlying, right? You think that the market is still going to continue going further down, then you could choose to be a little bit aggressive in the rolling of your delta. But do keep in mind that, the more aggressive you are, when you roll it to a higher delta, although you will get a higher credit, there is also a higher chance that you could be whipsawed, right? Because the market could go down and then all of a sudden the market could reverse back up. And because you have rolled to a higher delta, right now your short call strike down here is going to be much closer to where the market is. So this is one thing to keep in mind. But of course, if the market, doesn't go up and it continues going down, then rolling to 30 delta, right, would be the better move because you actually collect more credit. So it actually helps to reduce your overall risk. Now, the next question is, what do you do if the market actually does go up, right? So let me just remove this drawing. What happens is after you have rolled down and then the market all of a sudden bounces back up and now it tests your call side right now. So same thing again, you would also still roll based on delta. So at this point in time, you can see it's at 35 delta when the market is at this point. Now, when the market goes up, now this delta will definitely drop. So the question is, what is the point in time where you choose to roll this put strike up? So this ultimately comes down to your personal preference, right? You could wait until the delta actually drops below 16 delta, then you can start to roll this put option up. Or you could choose to wait until it drops to a single digit delta, let's say maybe 10 delta, then you roll it up. Again, there's no right or wrong answer here. It really comes down to how aggressive you are in wanting to, actively manage your strangle, your disposition. Okay, so keep in mind again, the more active, the more aggressive you are, the more you can end up over managing your disposition. Now, the next method is to roll when the short strike is breached. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So what that means is to roll the untested side only when either the short call or short put has been breached, right? So if the short call has been breached down here, then you'll be rolling the put side, right? On the other hand, if the short put has been breached, then you'll be rolling your short call down as well. So the short call on this hand would be considered the untested side. So let's say, for example, let's say the market has gone above your short call strike. So this is where you can consider to roll up your short put. So again, which delta do you roll it to? So at this point in time, when the market has already reached the short call strike, it's roughly around 50 deltas, right? So this is where, this is considered at the money options. So your short put most likely will be in the single digit, right? If you start off with something around 16 delta, because the market has really moved quite a bit already. So again, it's the same two options, right? You can either roll to the initial delta, 16 delta, or if you're a little bit more aggressive and you think the market, is going to continue going up. If you think the market is going to continue going up, you're very bullish on it, then you can choose to roll to a higher delta, right? Anything above 16, okay? Now, here's the question. What if after you have rolled the put option up, the market still continues to go up, right? So at this point in time, your strike has already been breached. So do you still roll up this put option down here? So this again comes down to your own personal preference. If you're just a little bit more conservative, right? You're afraid that, the market might come back down and you do not want to get whipsawed, then you can just choose to stop your rolling there. Alternatively, if you want to still continue to manage this position, then this is where you would now go back to method one, right? Method one, basically just see this delta only. If this delta has dropped to a single digit, then you roll it up again to re-establish the initial delta again, right? So let's say, for example, this delta down here has dropped to somewhere around, say, 8 delta, right? If it has reached around 8 delta, then at that point, you can choose to roll up to the next 16 delta again. Then you can keep doing this until roughly around 21 DTE. Then that's where you would choose to get out of the position if you want to, right? Again, this is one of my mandates. I will generally get out of any undefined risk strategy, especially undefined risk strategies around 21 DTE, because past that, the gamma will start to pick up. It's going to be much more risky for any undefined risk strategies that you have. All right, so method number three. So method number three is the most conservative one. So you roll only when your break even is breached. So for every strategy that you put on, there's always a break-even point. So for the Strangle, the break-even point is past your short strikes, right? And the way you generally calculate the break-even is you take the credit and then you add up, subtract to your short strikes, right? Depending, is it the short call or the short put? So let's say, for example, you receive a credit of $2.50 for this Strangle, right? So what you want to do is, for the call side, what you're going to do is just going to add this credit to your short strike. So if your short strike is at, let's say, 193, then you add on $2.50, then that's where your break even is, right? Your break even is going to be at 195.5, and on the put side, you just subtract it, right? So if it's at 173, then you subtract $2.50. So this is where your break even point is. So this means is that you only roll the untested side when the break even on either side has been breached. So this is an even more conservative approach compared to method two. So this way, you're actually, much more passive in terms of your rolling. Now, if you're not sure how to calculate the break-even price, even after what I just shared with you, then there is a simpler way, is that you can just simply just go to your, the payoff diagram or the P&L graph on your broker's platform, right? So for this is TD Ameritrade. Basically, you can just go to the graph and they'll tell you exactly where the break-even price is. So as you can see down here, the red lines on the left-hand side and the red line down here on the right-hand side, these are where your break-even price is, and you can just simply take it and then mark it on your chart. So you know exactly when the market has breached your break-even prices, right? So you can see down here, this is where your short put is. This is where your short call is. So this is a very quick way and easy way for you to see when your break even has been breached. All right, so for example, let's say the market has gone above your short call strike and it has breached the break even point above your short call strike, then this is where you can consider to roll up your short put. So which delta do you roll it to? So again, you should know by now, it's the same two options, right? The first option, right, you can roll it just to the initial delta. And option two, you can roll it to a higher delta. Now, the question is right now, what if the market continues going up? Well, in this case, then again, the same thing, we default back to method one, whereby we just look at this delta, right? So if the delta drops below a certain number, right, this number is basically up to you based on how actively you want to manage it, right? Once it goes below this number, then you can start to consider rolling your short put up again, or your short call down if the market, tests the put side. Okay, so now that I've shared these three methods with you, you might be wondering, hey Davis, which method should I go for, right? So which method is most suitable for you? Well, the answer really comes down to your trading style, right? So it depends on your trading style and how often you're able to monitor the market. So if you have lots of time to stare at the market and you like to actively and aggressively manage your positions, then go for method one, right? You can actively reduce your risk as you manage your deltas of your short strangle, but also do keep in mind that the more actively you manage your positions, the more actively you roll it, then there's a higher chance of a whipsaw as well. So again, there's no one that is best, rather it's just a trade-off. Now, on the other hand, if you don't have much time to watch the markets, or you like a more passive approach to managing your positions, then go for method 3. So basically method 3 is the most conservative, the most passive of all, because it takes quite some time before your break even is breached, and in many cases it might not even breach your break even. So a lot of the time you could end up not even rolling your trades at all, and you find that your strangle is just going to work out in the end. So if you're a little bit more passive, or maybe you have a full-time job that you're not able to monitor the markets, or maybe you're new to trading it and you do not want to get confused or overwhelmed by having to actively manage your positions, then go for method number 3. And if you like a good balance of both, then go for method 2, where you only roll when your short strike is breached. And this way is also pretty simple for you to just look at the charts, because you already know where your short strike is, and you don't also have to worry about calculating where your break even is. All right guys, so this is how you roll short strangles, and I hope this video has been helpful for you, and if it has, please give me a thumbs up. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.